The effective closure of the Strait of Hormuz has trapped exactly 3,200 vessels, initiating an immediate and severe supply chain chokehold. The immediate reaction in physical commodity markets was violent, sending Brent crude volatility spiking aggressively near the $110 a barrel mark. This chart shows the widening divergence between Brent and WTI crude. The massive $16.50 spread between the two benchmarks quantifies the structural supply distress isolating the Eastern Hemisphere. Markets are currently experiencing a tactical relief rally. Traders are betting entirely on the prospect of a U.S.-led evacuation mission, pricing in a quick diplomatic resolution rather than trading on economic data. This physical bottleneck establishes a permanent new baseline for global pricing. Any traditional supply chain assumptions built for the first quarter of this year are now mathematically obsolete. The resulting macroeconomic regime is an acute, unavoidable stagflationary environment. Stagflation is an economic cycle characterized by slow growth and a high unemployment rate, accompanied by persistent inflation. This supply-side imported energy shock collides directly with the inherently restrictive posture of the Federal Reserve and its chairman, Jerome Powell. Central banks are now trapped in a policy deadlock. They cannot lower interest rates to stimulate economic growth without hyper-accelerating the energy-driven inflation currently burning through the supply chain. The current upward bounce in the markets is an illusion. It serves only to mask deep institutional liquidity drains and severe regional fragilities beneath the headline indices. Broad index returns will no longer protect capital. Institutional survival now requires mapping the asymmetric regional decoupling across global indices based on their specific energy constraints. Institutional capital is actively fleeing risk on equities and rotating aggressively into specialized safe haven bids. This flow chart traces capital draining from risk equities into two primary reserves. The DXY is holding above 100, while gold has recovered to hit $4,650 an ounce. A secondary channel routes capital into Bitcoin at $70,394, capturing a unique risk-on hedge flow. Shifting focus to U.S. equities, the S&P 500 is oscillating precariously near the 6,680 pivot point. The index faces dual fundamental pressures. Core inflation remains sticky, accelerated by the Brent-WTI oil spread, while the labor market is finally entering a cooling phase with unemployment hitting 4.4%. This chart displays the S&P 500's technical setup. A death cross has formed on shorter timeframes, signaling a bear market transition. Critical support rests at 6,550. A sustained breach of 6,600 will trigger cascading algorithmic liquidations, targeting the 6,400 floor. The European market faces an even steeper hurdle. The German DAX is struggling to maintain its footing above 23,500. The primary catalyst for this structural weakness is physical damage to the Qatar LNG facility, triggering a 128% surge in European gas benchmarks. LNG, or liquefied natural gas, is natural gas cooled to a liquid state for shipping and storage. This chart illustrates the DAX daily timeframe. It shows a bearish flag, a technical continuation pattern consisting of a brief upward consolidation before a downward breakout, locked strictly beneath a 24,100 resistance ceiling. Imported energy inflation forces the European Central Bank to maintain a highly restrictive hawkish stance. This severely punishes rate-sensitive sectors like real estate and utilities. Transatlantic equities are trapped in a structural margin squeeze. With the Federal Reserve and the ECB handcuffed by energy costs, their traditional intervention tools are completely neutralized. Asian markets face a different vulnerability. Japan operates as a net oil importer, exposing its domestic economy entirely to the maritime shock. The Bank of Japan is caught in its own specific iteration of policy deadlock regarding its currency valuation. This chart tracks the dollar against the yen, pressing the 160.00 threshold. The Bank of Japan cannot raise rates without crashing the economy. Furthermore, the Nikkei's bounce to 54,100 is an illusion. Shadow futures show it perfectly matching U.S. tech trends, not domestic strength. Technically, the Nikkei leaves a bearish gap at 54,500 that must be filled to signal a true trend reversal, while the 52,800 level remains the critical demand zone. By contrast, the Middle East is executing a distinct geopolitical anti-fragility play. The Abu Dhabi Securities Exchange is capturing massive local fiscal surpluses generated by the current energy supercycle. This chart of the ADX highlights a tightening bullish pennant formation, a technical pattern indicating a brief pause before the continuation of an upward trend. The index sets near 9,571, wedged perfectly between 9,450 support and 9,800 resistance. Escaping global capital is aggressively rotating into sovereign-backed large-cap entities like ADNOC and First Abu Dhabi Bank. This alpha generation is balanced against the local tail risk of retaliatory naval maneuvers near urban centers, forcing funds into a defensive posture. Physical proximity to the conflict dictates a strict preference for low-beta, sovereign-backed names, starving highly volatile mid-cap stocks of liquidity until naval freedom is restored. Geographic energy dependency strictly dictates index survival. Importers like Japan face currency collapse, while exporters like the UAE capture the escaping global alpha. The Indian market serves as the perfect microcosm for diagnosing the true underlying health of the global equity bounce. The Nifty 50 has reclaimed the 23,000 headline level. However, this surface number masks severe structural weakness. This chart compares foreign institutional investor, or FII, flows against domestic institutional investor, or DII, flows for March 9th. This exposes the real mechanics hidden within the order book. Foreign institutions executed aggressive, unabated liquidations, totaling negative 6,345.57 crores. This massive outflow was met by domestic buys of positive 6,971.51 crores, acting as a temporary and fragile domestic cushion. Foreign dumping absorbed entirely by domestic capacity proves extreme liquidity fragility beneath the rally. The India VIX, a measure of the market's expectation of near-term volatility, is surging above 22.80. This provides undeniable quantitative confirmation that the market is operating inside a fear regime. The index's stability is an illusion maintained solely by retail and domestic liquidity. Mathematically, this absorption must break under sustained foreign capital flight. Synthesizing the macro and institutional flow data establishes a clear professional trading mandate for the weekend: the defensive pivot. Portfolios must maintain high cash ratios to safely navigate the binary diplomatic outcomes of the Hormuz standoff. Allocators require a specific sector rotation strategy, explicitly overweighting IT and public sector undertaking, or PSU, energy equities. These specific sectors serve as the only mathematically sound hedge against the dual threat of rising Brent prices and depreciating local currencies. This chart focuses on the ultimate downside technical trigger that allocators must monitor: the Nifty 22,700 critical support level. A failure below the 22,700 line fully invalidates the domestic absorption thesis. It confirms a direct transition into a structural bear market. Until a verified maritime framework is established by the International Maritime Organization, any long delta positioning, trades that profit from upward market movement, is explicitly fighting massive institutional flow. Capital preservation remains the singular viable strategy.